So good afternoon. My name is Michiel Mannaerts. I lead our Swiss Treasury practice in Switzerland, focusing on Treasury transformation, cash management, Treasury technology, and also on the topic of accounting. And this is going to be the subject of this session, to provide you with an update on some of the developments which are relevant for treasurers. And there's quite a few. So what I wanted to cover with you is IFRS 9, provide you with an update on what's happening there, and this is really the good news that I can bring to you, and provide you with an update on what's happening on the lease accounting side, which is probably not such good news, and also provide you with an update on what's happening with notional pooling, which I think is also a topic which is going to be discussed later on. So, why is this interesting for treasurers and also for banks? There's some developments that really will allow you to do some things which you cannot do today. At the same time, there's also some developments which will mean that certain things you are doing today you won't be able to do in the future. So, one of the challenges here which treasurers face is how to achieve alignment between what you're trying to do from an economic point of view and what you're trying to do from a risk management point of view, and to try and get that properly reflected in your financial statements. And that's really the backdrop of these accounting regulations. How to best use these regulations to your benefit to really show alignment between what you're doing from a risk point of view and how that then reflects in your financial statements and how your investors look at that. And that's a backdrop to the topics we're going to cover today. And what you see on this slide is the timeline of the regulation we're going to speak about, which is IFRS 9, which is let's say the new version of IAS 39. I think a standard which has been built up quite a reputation for itself in the Treasury space, with a lot of criticism being expressed by the Treasury community on this standard. And it's no surprise that it took a lot of time to actually get IFRS 9 out there. It took 15 years for the standard setters to develop IAS 39, and as you can see, it's taken a good 7 years to get from the first issuance of IFRS 9 to a final version this year, and which is only going to be effective as of January 1st, 2018. So also there, we're looking at a good 10-year project, and it's not even fully done. Main components of IFRS 9 is fourfold. So there's the portion which deals with financial assets. There's the part which deals with financial liabilities. There's the part which deals with impairment, and then there's the part which deals with hedge accounting. Now, luckily, the financial assets, liabilities, and impairment won't be too much of a worry to corporate treasurers. It's a relatively small effort to adapt to this new standard. It is a very big thing for banks. It's a very, very big thing for banks. So they will have huge projects to deal with this. For the corporates, the part in IFRS 9 is really what's really interesting is hedge accounting, and that's the part which I want to focus on mainly for this presentation. Just to give some more perspective on the timeline, so this standard is already out. There's only one piece which is still being worked on, which is macro hedge accounting, which is more for the banking sector. But this standard is out and available, and it's available to be used by companies who are not in the European Union, so who can early adopt the standard. If you are in the EU, then you are only able to use this standard as of the 1st of January 2018, pending endorsement by the EU. So let's move on onto a little bit more detail about hedging. So basically, one of the key developments in IFRS 9, as mentioned, is the improvement in hedge accounting that is available. So we've moved to a more simplified and more aligned approach to the risk management strategy of companies. We've gotten rid of this horrible 80 to 125% rule, which is insane if you think about it, because if you're 79% effective, you won't get hedge accounting, and if you're 81% effective, you will get hedge accounting. I mean, at EuroFinance a number of years ago, I remember very well a question asked by one of the group treasurers to Sir David Tweedy, at that time the chairman of the ISB, trying to get some perspective on this nonsensical rule, and I'm very happy to see that it's going. Some limitations have been removed, which is good, and there's also some exposures which are now allowed to be covered, which was not possible in the past, and I'll provide a little bit more detail on that. Also, the possibility to use options has also increased. If we focus on kind of the main benefits which we get, as mentioned, it's no longer this highly effectiveness requirement of 80 to 125%. It's the ability to hedge aggregated exposures, and I'll go into a little bit more detail in some of those examples. The ability to hedge non-financial exposures, and I think that matches well with the previous speaker's presentation on commodities. The possibility to use options, this new concept of rebalancing, and then also the point of basis adjustment. Hedging of net positions is a topic which is improved, but not sufficiently to kind of solve the problem that exists there, so I won't spend too much time on it. So let me start with the aggregated exposure, and I think this is going to be good news also for the banking sector, because in the past the IAS 39 did not allow to construct a hedge accounting relationship with a derivative as an underlying. So if we take this very simple example here of a floating to fix swap used by an issuer to convert its debt profile, if at some point in time we would want to translate that profile into a different currency, and if we were to have a hedge relationship already in place on the underlying structure, we get into trouble, right? We cannot use a derivative as an underlying in a hedge relationship. That means we cannot get hedge accounting for this new cross-currency swap which we've put on it. And that, of course, is off-putting for a lot of corporates, so they may not go into a transaction like this. Or, alternatively, they would need to, basically de-designate the hedge relationship, kill it, and start a new hedge relationship by combining these two swaps into one, and link it to the underlying debt. Both of which are not desirable. Now, luckily, IFRS 9 does actually allow you to have a derivative as an underlying, so you can actually take a piece of debt and a swap and combine that as an underlying in a hedge relationship. So you can apply layering, and you can do different layers if you want even. So there's a lot of flexibility which you as corporate treasurers have here. So we think that's a very good development. So IFRS 9 is good here. Second main improvement is around non-financial risk components. So I'll illustrate that with an example here. If we look at the costs of a can, and where 90% of the cost is the underlying aluminium price and 10% is other costs like raw materials, labor costs, maybe marketing, what have you. So in the past, if we wanted to construct a hedge relationship to cover the aluminium price risk, we were obliged to take the whole risk of the underlying. So all the costs related to the aluminium can, we were not allowed to isolate the aluminium price component, which is problematic, because then it creates all kinds of ineffectiveness in the hedge relationship, and it therefore is often not a valuable alternative for corporates to actually use, because they want to get their numbers right, and therefore it may actually keep some corporates from hedging these type of risks. Now, IFRS 9 has addressed this, so it is possible to isolate non-financial risk components. So it is possible to actually hedge the aluminium price component of a can, or it is possible to hedge the crack spread in a tolling agreement, or there's a whole range of commodity risks that you can isolate and effectively apply hedge accounting for. So we think this is a really very good development. Third improvement is around the use of options. So in the past, IAS 39 would allow us to construct a hedge relationship where we'd use the intrinsic value of the option to be associated with the underlying hedge risk. But the time value would remain as a kind of free-floating P&L item and generate P&L volatility, which is undesired. Now, in IFRS 9, we are moving a little bit back in time. We're going to what is the kind of old GAAP approach almost, where we can actually take the time value and allocate it to OCI, to the hedge reserve. We can keep it in equity, and we can release it. And the way we will release it is effectively when it's transaction related, we release it when the transaction occurs. So if we use an option to hedge a piece of machinery, then we release the time value and make it as an adjustment on the purchase price of the equipment and then capitalize it on the balance sheet. If the underlying exposure is time related, we can then take the time value, park it in equity and release it over the life of the underlying item. So again, that gives you a steady flow, a steady P&L number, rather than having to explain the volatility in change of time value. So we think that's a really good development. Fourth point is around rebalancing. So rebalancing is the IFRS 9 way of allowing partial de-designation. So if you have a hedge relationship and you have a certain forecast, but that forecast changes, you can actually reduce your hedge, and you can take that part of the hedge and the hedge reserve you've built up over that, which sits in equity, you can then release that to P&L, but you can maintain the original hedge relationship. So to give you an example, an entity is planning to buy coffee for 6 million in September. They hedge it, but then their forecast reduces to 4. So basically, we've got a forward outstanding. The forecast changes, so we are unbalanced. So from a risk point of view, we're allowed to make an adjustment. We can take 2 million worth of that forward out of the relationship and take whatever mark-to-market is associated with that to P&L, and we have a working hedge relationship. Again, we think this is a great improvement, and it clarifies how we can best do that. Next point, which is not necessarily an improvement. Here it's more of a restriction. We don't think it's a big thing, but in the past there was the choice to actually either keep my hedging results in equity and release them when the underlying exposure affected P&L. Now IFRS 9 requires us to make a basis adjustment. So if we have inventory or property, plant and equipment, we need to make an adjustment on the underlying asset or liability on the balance sheet. Not a big thing, but it's just a practicality. So all in all, some 5 very good developments, and from my perspective, making the life of corporates a lot easier. So that was the good news. Now we move to the bad news. So lease accounting, which is IFRS 16 upcoming. Today, under IAS 17, we know a model where we have finance lease and where we have an operating lease. So as you know, finance lease means you have an asset, you have a liability, you have a depreciation, and you have interest expense. Operating lease is very simple, no debt, no issues, good for your gearing, but you have your lease expense. Unfortunately, that model is going to go, and we're going to go to a model where we have a right of use asset. So all operating leases will disappear, and that means all corporates will actually have to recognize a lease liability and also the associated depreciation expense and interest expense. Now that's going to have major impact on the way balance sheets look. So we're expecting this to affect gearing ratios, capital ratios. So we will see rent expenses replaced with depreciation interest expense, so there will be a move from above the line to below the line. Loan covenants and even credit ratings may be affected. This is going to be applicable as of January 1st, 2019. So, PwC wouldn't be PwC without doing a good study about it. So we've actually looked at that for 3,200 companies. And we've looked at what does that mean for balance sheets. So we see that industries with heavy use of rentals are strongly affected. So we see retailers, we expect a median debt increase of 98%. We see an increase in EBITDA because of course there's a shift between above and below the line. We see a change in leverage, which is very, very significant. And economically, there's not necessarily a change, right? It's the same contract, but companies will have to explain this to investors and analysts, and this will have impact. Now, just to kind of clarify, this only applies to lessees and not to lessors. So lessor accounting is unchanged. So this is the bad news. Then there's some more bad news. So this is then on notional pooling. Recently, IFRIC, the IFRS Interpretations Committee, issued a clarification on notional pooling. One of the big questions around pooling has always been, am I allowed to offset my assets and liabilities of my cash pool? In the past, there was a divergence in practice observed in the market, and many corporates achieved this offset, and that was achieved by demonstrating legal right of offset, and then also by demonstrating the practice and intent of net settlement. There's been a change in interpretation around that, and today the practice of doing a sweep during the reporting period to kind of show this intent of net settlement is no longer sufficient. So the standards has evolved on that, and it's now required to really demonstrate that the actual balance at year end is the balance that you intend to settle net. This is a very fresh development for this financial year, and definitely recommend clients who are exposed to this to have a look at that topic and explore that with their auditors. So all in all, some good news on the hedge accounting front, some less good news on the lease accounting and notional pooling front, but I hope that was a useful, quick 15-minute update, and thank you very much for your attention. I don't know if there's any questions, but I'm not sure if there's a mic for the people in the audience, but nope. Right, I'll leave. Okay. Okay, so question here for the from the audience is, so what's the biggest benefit of IFRS 9 for corporates? I would say clearly around the commodity, commodity hedging. I think for a lot of companies who are active in the procurement space, this is going to open up a whole new avenue of risk management, because a lot of companies hesitated being active in that space because of the limitations that existed from an accounting perspective. So this is, from our perspective, a very positive change, and we're also very happy to talk to any of you who have questions on that and would like to explore that topic further, what this can mean in a positive sense for you. Thank you very much.